All right, guys. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. In today's session, we'll be doing one final accounts question, that is presentation and preparation of financial statements is the area that we are going to attempt. We are going to attempt a question which you haven't seen before. It's not really available in your examination kit. You most likely won't find this kind of a question anywhere else. So I have just gathered this question so that we can challenge ourselves. All right. So that's the whole purpose. Do it with that mindset. And again, while you're watching this video, I want you to be, I want you to be very alert, right? Try to stay ahead of me. Whatever I'm trying to do, just try to solve it on your own and then let me know what's your answer. All right. So let's begin. The name of the question is Gamow Limited. And it says the financial controller at Gamow Limited has prepared a list of nominal ledger balances for the year ended 31st March 2050. Now, whenever you are in a real exam, you are given with the opportunity to highlight important things. Always make sure that you highlight the year end. Always highlight the year end. It will help you a lot. So it says that the year end is 31st March 2015, which means that your year start would be, I can even write it down, year end is 31st March 2015. Yeah. And that means that your year start would be 1st April 2014. So these are the relevant dates that you never forget. Okay. It says that, however, there are some issues which need to be finalized before the financial statements can be prepared. And that is where you come in. You are the financial controller's assistant, and you have been provided with the following information and asked to prepare the financial statements. You are responsible for preparing the financial statements of a single entity. Now, before you even go and prepare the financial statements and even rectify the errors that have been done, you are provided with a certain list of ledger balances. Basically, you are given a trial balance, and you need to go through that trial balance and see if there are any shortcomings or not. So you see that the revenue of the trial balance is $1,896,200. But there are some notes, note 1 till 3, that you still need to refer. There are, you have been given purchases will be helpful for you when you are calculating your cost of sales. You have been provided with administrative expenses of 283,600. You have been provided with other operating cost of 189,720. You have been provided with ready-made finance cost of 1560. 1560 finance cost means interest expense. So interest expense have been provided to you with a value of 1560. Property, plant, and equipment have been provided to you at 1260780. There are some intangible assets as well with a value of 275,000, but there is a note that your examiner wants you to refer. So there must be some adjustments that the examiner wants you to do. There are inventories at 31st March 2014, 45,600. Most of you might have guessed it by now. These are inventories at 31st March 2014, whereas your year end is 31st March 2015, which means these inventories given to you are opening inventory, exactly. Trade and other receivables 121240, cash and cash equivalents 3800, ordinary share capital 580,000, retain earnings 238170, but this is a debit balance. Can any one of you tell me what do you mean by a retained earning debit balance? What do you mean by a retained earning debit balance? What do you mean by that? Generally, you see, yes, very good. It's a loss. It's a negative retain earning. You see, retain earning is always part of equity. And whenever equity is positive, it gives a credit sign. It gives a credit balance because it's a credit nature thing, na? Therefore, whenever you see the opposite, you see a debit balance. It means the sign is also, opposite. It's a loss figure. So you have been given with retained loss brought forward. Okay. Then there are some 6% convertible bonds. There is a note attached to it with a value of 300,000, trade and other payables 92,400. And then you have been provided with some provision of 120,000. So all in all, you see that there are multiple accounting standards that must be tested in the question. Intangible asset, that means IAS 38 is there, right? Then you see convertible bonds, you see IFRS 9 is there. Provisions, you see IS 37 is for sure there. So this kind of glimpse you get whenever you see a question in your exam. All right. Now you have been provided with various notes that we need to solve. But if you go and look at the bottom of the question requires you to prepare a statement of profit or loss and other comprehensive income for the year ended 31st March 2015. So you need to prepare a P&L and OCI. And for the B requirement, you need to prepare a statement of financial position. So it's a traditional final accounts kind of a question. All right. Now let's go and study about each of the notes. Examiner says under note number 1, it says on 1st July 2014. What do you mean by 1st July 2014? You see, your accounting year end is 31st March 2015. And when your examiner talks about 1st July 2014, this is technically 9 months before the year end. 9 months before the year end. So 9 months before the year end, Gamow Limited introduced a discount loyalty card scheme for select customers, issuing 200 cards on that date for $1250 each in return for a 25% discount on all purchases over the next 2 years. So what is basically happening? You see, every company wants to increase their sales. And when you want to increase your sales, you try and come up with different type of, advertisements and different type of techniques in order to increase your revenue. I'll give you an example. You see, I recently offered a 77% discount on all my courses for a particular day. Anyone who registers till 14th August, I'm going to offer them 77% discount on, on any course that I'm offering. This is an exclusive discount. What's the intention? You see, let's be honest. The intention is that anyone who registers availing this particular opportunity, will come to me and avail that particular discount. But at the end of the day, I will be, I'm attempting to try and increase the number of students that I teach. Yeah. Whenever you try to reduce the price of a particular commodity, your revenue tends to increase. That is law of demand. So what Gamow Limited has tried to do 9 months before the year end, they have just introduced a particular loyalty card. And they are saying if you buy this loyalty card, the advantage of having this loyalty card is that you will be able to avail, you will be able to exercise the benefit of this loyalty card over the next 2 periods. So basically, I'm selling you something right now and providing you a benefit for the next 2 years. All right. So I have just sold 200 cards on that date for $1250 each. Just imagine, I'm going to write working number 1 and I'm going to write, you can write any name, let's say loyalty scheme. So under this loyalty scheme, I have collected cash of $1250 each on 200 cards. So how much money have I collected right now? How much money have I collected right now? I have collected, wait for a minute. Yeah, I have collected $250,000 on which I am promising you that I will allow you a discount over the next 2 periods, over the next 2 years. Guys, I want your feedback. Come on, come to me. I have just sold some cards worth $250,000. And I am telling you that through this scheme, selected customers whosoever register into this scheme will be our most loyal customers. And as a result of giving me sales right now, I promise you that you will be receiving a particular discount over the next 2 periods, right? And I've collected the cash right now. I've collected some amount of income right now. I've collected some amount of revenue right now. But what will you get against this? What will you get this against loyalty card? What will I provide you against this revenue that I have received from you right now? I'm going to give you a discount over the next 2 years. Guys, just let me know, give me your feedback. Don't you think that against this $240,000 of revenue that I have collected, my performance obligation will be satisfied over the next 2 periods. Do you guys agree? I have collected some amount of income right now, but my promise to you is not to provide goods right now. I'm saying whenever you come in future, because you are my selected customer, you are my core customer, you are my selected customer, I will provide you some form of discount over the next 2 periods. My performance obligation is to provide you a discounted product over the next 2 periods. Yes. So can I say my performance obligation is spread out over the next 2 periods, over the next 2 periods? Agreed? Huh? Examiner says, just listen to this. Examiner says, the financial controller included the total cash received of 250,000 as part of revenue for the year ended 31st March 2015. An analysis of purchases over the last 5 years for these customers show that the monetary value of their purchases is evenly spread throughout each year. What has your financial controller done? Your financial controller has recognized the total amount of $250,000 as revenue this period. Is it correct? Just let me know, is it correct? My performance obligation, and remember, customers will buy equal value of goods each month till the next 2 years. We started from 1st July 2014 till 1st July 2016. Customer will buy equal amount of goods for the next 2 periods. But I started this scheme on 1st July 2014, and even till the year end, my performance obligation would have only been satisfied for 9 months. For 9 months. But what has your examiner done? What has your financial controller done? Your financial controller says, "No, entire $250,000 is our revenue right now." Is that correct? Is that correct? No. I can easily write, and I want your feedback. Revenue of these cards should be recognized over the next 2 years when performance obligation is satisfied. Do you guys agree? When our performance obligation is satisfied. Agreed? Do you all understand this? Agreed? Just let me know if this is okay. Everyone, I want feedback from everyone. Is this clear to you? Revenue should be recognized over the period of time, over the period of 2 years, right? So that means some amount of revenue that your examiner has recognized needs to be reversed. If I were to ask you what is the total cash received, if I were to ask you what was the total cash received, you would say 250,000. Now there are two portions to it. Some portion is realized within this period, which is of 9 months. And the rest of the portion is basically unrealized cash, which has been received by you now, but you haven't earned it yet. It is unrealized income. It is a contract liability. It is advance income. Don't you agree? So 250,000 multiplied by 9 divided by 12, you can say, divided by 24, you can say 93750 worth of revenue, worth of performance obligation would have been satisfied by this accounting year end, but the rest should be recognized as an advance income. How much should be recognized as an advance income? 156,250 is basically advance income, or what you call a contract liability, which you have received till now. Do you all agree? Do you all agree? Make sense? So basically, examiner recognized the entire 250,000 as revenue, whereas 156,250 is not realized. That particular revenue needs to be reversed. That particular revenue needs to be reversed. And if I were to ask you what would be the accounting entry to reverse this revenue, remember, in your examinations, you are not required to prepare accounting entries. You are not required to do so. However, I prefer that my students often prepare accounting entries so that their concepts are very clear. Their concepts are rock solid. So I need to reverse some amount of revenue. So revenue should be debited by 156,250. Agreed? And Against this, a contract liability should be recognized of 156250. Do you all agree? Do you all agree? I want feedback from everyone, and that should be very quick. Make sense? Make sense? Uh-huh. Acha, I want to ask you one more thing. Our contract liability or our advance income is 156250, that's for sure, right? This we need to show as our liability. If I were to ask you that what is, I'm writing therein means, the breakup of 156250. If I were to ask you what is therein current liability and what is non-current liability, so can you guys tell? Can you guys tell what should be the current portion and what should be the non-current portion? Can you guys tell? You see, current liability is any liability that is satisfied within the next 12 months of the reporting date. And whatever liability is left, which is not settled within the next 12 months, is always supposed to be the non-current liability. Make sense? So you see, your total amount of cash received was 250,000, right? In the next 12 months, can I say divided by 24 multiplied by 12? 125,000 worth of advance income will be realized in the next 12 months. In the next 12 months, this should be your current liability. Make sense? This is 12 months from 1st April 2015 to 31st March 2016. Make sense? And the remaining should be classified as non-current liability. These go beyond 12 months. Do you all agree? And remember, whatever I'm writing here is not required by your examiner. I'm just writing these stuff so that you understand it better. Your examiner does not want you to make accounting entries. If you can do it directly, then that's fine. Examiner does not want you to write these kind of narrations or these kind of words. It is not required, but I'm just trying to explain it to you guys, and that is why I'm writing it here. Is that good with everyone? And I keep on asking is that if that's good with everyone, because I want to make sure that my people understand what I'm saying. Is this okay with everyone? Done? All right, let's move forward. Very good. We also need to make sure that we don't spend enough time, more time as compared to what is allowed. Okay. So working number two. Working number two, it says during the year ended 31st March 2015, which is this accounting period, by the way, Gamow Limited incurred $275,000 of research and development expenditure on a new product, the Mendel. Recently, Gamow Limited has spent $275,000 on research and development. Can anybody tell me which accounting standard are we exposed to here? Which accounting standard comes into your mind when you see this word research and development? IS 38. And according to IS 38, any expenditure incurred on research and development should be classified either as a research expense or a development expense, right? All research expenses by default go into P&L. All development expenditures also by default go into P&L, but where a substantial pirate criteria is met, you are allowed to capitalize. Agreed? Very good. Everybody is on the same page. Excellent, guys. So examiner says during the year ended 31st March 2015, Gamow Limited incurred $275,000 of research and development expenditure on a new product, the Mendel. All of this expenditure was capitalized as an intangible asset. By the way, the entire 275,000 has already been capitalized as an intangible asset. That's already done. It's already done, right? Examiner says all of this expenditure was capitalized as an intangible asset. The cost incurred are shown in the table below. In the table, you see the breakup of this 275,000. And with the help of you, we are going to decide what goes as a research expense, what goes as a development expense, but not capitalized, and what can be capitalized. All right. So I'll keep on asking you answers and you give me the answer yes or no, if this is going to be capitalized, yes or no. Okay. So the first thing is From 1st April to till 31st May, for the period of 2 months, we did some background investigation work which costed $25,000. Can we capitalize this $25,000? Yes or a no? And everybody needs to answer, guys. Very good. So this goes in P&L. Excellent. Initial development work, 1st June till 15th July, 42,800. Should this be capitalized? Initial development work. It doesn't seem that it's a relevant expenditure because your examiner is saying initial. So it seems as if the criteria of pirate was not met up till these dates, but we still need to see. We still need to see. But most likely 42,800 will not be capitalized. Agreed? Then its second phase, development work, $160,000. It's again development work, but this is the second phase, right? Second phase would have come after the initial phase. Why would you start a second phase of a development project? Why would you start a second phase of a development project? Because most likely you would have concluded that this development is viable and we need to proceed with this development and develop the product finally for the purpose of commercial sale. That is why most likely you would have developed. You would have gone towards the second phase. Otherwise, you would have stopped yourself. So most likely this is to be capitalized. Let's see as we move forward. Product launch cost, December 2014, $31,600 incurred on product launch. On product launch. Seems like a marketing cost. Can you capitalize a marketing cost? No, no, marketing cost can never be capitalized. Marketing occurs when the development is already complete. Then you market. It's not a development cost, so to say. It should go in P&L. Staff training cost. Can we capitalize staff training cost? No, no, very good. So at least 2-3 things we for sure know it's not to be capitalized, and something we need more knowledge of whether that can be capitalized or not, right? So examiner is providing you further details with regards to this, and then you decide what amount should be capitalized only out of 275,000. You guys have to tell me, okay? The Mendel, the product, was assessed as being commercially viable on 16th July. The company concluded that the product was commercially viable when they concluded this on 16th July, on this date. And product development was completed by the end of November 2014. During this period, the product was launched in December, although the first products were not delivered until the year end, which is April 25, April 2015, although our year end is 31st March. So the product was not sold within the year. So no amortization has to happen. Can you guys tell me what amount only can be capitalized out of 275,000? What amount can be capitalized? Examiner, by the way, has capitalized the entire 275,000. But what do you guys think? What amount can be capitalized? What amount can be capitalized? Only 160,000 can be capitalized. You see, the background investigation work is research work. Research, you remember the definition of research? Initial planned investigation to obtain new knowledge. New knowledge of being obtained, 25,000 cannot be capitalized. 42,800 cannot be capitalized because commercial viability was only apparent on 16th July. Commercial viability was only apparent on 16 July. So any cost incurred before this date cannot be capitalized. The development was complete on 30th November. The development was complete at the end of November. So that means after that, whatever cost occurs cannot be capitalized. So you see, only 160,000 can be capitalized. Rest of it cannot be capitalized. Let me just go here, write working number 2 and write research or R&D for short. Total expense, guys, was 275,000. To be capitalized, What amount to be capitalized? Only 160,000. And that means what goes in P&L to be charged off in P&L? What amount should be charged off in P&L? The rest of it, 115,000 should be charged in P&L. Now, what your examiner has done, examiner has capitalized the entire 275,000 amount. Examiner has capitalized each and every amount. Is that correct? Is that correct? No, you need to reverse. What should be the entry for correcting this stuff? What should be the accounting entry for correcting this stuff? Guys, most likely, you will debit your P&L. You will debit your P&L. Most likely, let's say cost of sales. You will debit your cost of sales, 115,000, and I can write a debit here. And you will credit your intangible assets. Make sense? P&L debit, intangible asset credit. Is it clear to everyone? Is it clear to everyone? Give me a yes or a no. Is it clear to everyone? Done. Acha, answer me this. Can we start amortization right now? Can we start amortization right now? We cannot start amortization right now. Somebody just said in the group that, sir, we should start amortization for the period of December till March. We should do amortization from December till March. The answer is no. You know why? You know why? Because the product was launched in December. Although the first products were not delivered until April 2005, that means your product was only available for delivery from April 2015. That is from next year. Throughout this year, there was no opportunity of delivering that product. That means you are not commercially ready. You are not commercially ready. The product was launched. Okay, we told everyone that, okay, the product is coming and so on and so forth, but we did not launch it formally. It was not available for sale. Since it was not available for sale, there were no economic benefits supposed to arise, and therefore you cannot charge a corresponding expense. Otherwise, there will be a mismatch. You will be charging expenses as depreciation, but there will be no economic benefits. There will be a mismatch. Therefore, remember, no amortization can take place. No amortization can take place. Sir, you told us in our lecture, sir, that amortization can only begin once the product is launched. When I said the product is launched, the product should be available for sale now. Here your examiner is saying the product was launched in December 2014 but was not available for sale. It is just like, for example, I tell you that I am going to launch my AFM course. Advanced Financial Management course I am going to launch. It is launched. And you guys come to me and ask me, sir, can we enroll in your AFM batch? I say, no, it will start next year. Then what do you say? Sir, technically speaking, if you're going to start your batch next year, it's not launched. I mean, you are saying it's launched, but it's not launched because we cannot buy that thing. It's not launched. Make sense? So whenever you are preparing your financial statements, you always need to refer to substance over form. The substance, the reality is, although the examiner is trying to use the word launch, but it's apparent. The first products were only available for sale from 1st April. So it's nothing done within the accounting year. All right. So no amortization. Okay. Just make sure, just remember that we need to accommodate this accounting entry while we prepare our financial statements. All right. All right. So it says one more thing. Okay. 2,000 advance orders were taken during the product launch event. This is one more indicator. This is one more indicator that the product was not available for sale. You took advanced order during the launch event. Launch happened on December 2014. The product was not available for sale. You received advanced orders. Just like you can place advance booking for iPhones that come next year. You know, they are not available for sale till now. 2,000 advance orders were taken during the product launch events, with customers paying deposits of $50 per Mendel. The only accounting entries made in respect of this advance orders were to recognize the cash deposits and credit revenue. Okay. Guys, you have received a deposit. How much deposit did you receive? 2,000 orders, multiply by $50. You received orders, you received a deposit of $100,000. What did your accountant do? What did your financial controller do? All right, so there's a question. It means we have to see that is the product is available for sale or not, no matter it is launched or not. You see, okay, let me be very clear. The question that a student has asked is, sir, that means whenever we need to see if we can start amortization or not, we look for the word sale. We do not look for the word launch. Is that correct? You see, whenever an accountant is preparing financial statements, he is working in the real world, right? And in the real world, you need to use substance. Substance meaning you need to use your brain to take your decisions, right? You understood the point of view of IS 38. IS 38 said, please do not start amortization before you have the capability to receive economic benefits, right? One indicator of you being capable is that you have launched something. Launching something, launching a product for public sale is also launch. So as a figure of speech, anybody could say that please do not start amortization till the product is launched, right? So in general terms, whenever you launch something, it is available for sale. Yeah. So launch and sale are one and the same thing. These are interchangeable words. But in this particular case, the launch was done way before the product was available for sale. Now, if a student comes to me and say, sir, but the word you said in your lecture was launch. The word you said in your lecture was launch. I can show you the recording. Then I would also say, guys, I also made a story behind it. I told you that launch means that the product is available for sale and it starts to earn you economic benefits, and then you charge amortization so that matching is done. I would argue that did you not listen the other part which I said with the word launch? You see, in real life, you are not going to be given with exact words. You need to use substance. You need to understand what IS 38 was trying to say. IS 38 was trying to say that please prefer matching. Please prefer matching. If you do not prefer matching, then there will be a mismatch. In one period, you will be recognizing expenses, and in the other period, you will be recognizing income. So in one period, your P&L will go down, although and in one period P&L will go up. You will feel that in one period you have made a loss and in another period you have made a profit, but that is not transparent view of financial affairs. So in order to make sure that you do performance reporting so that your shareholders get to know exactly if they have made a profit out of the new product Mendel, yes or no, you need to match their cash flows. Yeah. If I ask you, let's say, Ansh, if I ask you that, if I ask you, you are working somewhere, you are doing a job, right? And I ask you if this job is worth it or not. What do? You say, okay, sir, I do a job somewhere. I'm paid a small stipend of, let's say, 25,000 rupees. And then I take my bus expenditures, then I take my my meals cost and my traveling cost and my mobile cost and this and that. If I accommodate everything, then I say, okay, it's a profitable job to do, right? But if you were to think that, okay, I arrive through a bus to my office, but that is the money that I already incurred, na? But salary I will get next month. So I will not accommodate all the costs that I have incurred in order to arrive at the office each and every day of the month and then receive a salary. If you think that 25,000 rupees salary that you receive is your pure profit, then you're mistaken, my friend. That does not make common sense. If that was the case, everybody would tell you that whatever salary you receive is a bonus for you. No, it's not a bonus for you. You need to incur cost to achieve that salary. So whatever is left with you after incurring all necessary expenditures, that is your real profit. If that is the story of your life, isn't that the story of your shareholder as well? Your shareholder wants to know that you developed a new product, Mendel. He wants to know if that is a profitable product or not. You would need to match the relevant cash flows now. So you will only try to recognize amortization as an expense to in the period in which revenues are expected to come. Not really coming, but expected to come. So that your shareholder can really see if that Mendel new product is a profitable product in your P&L, yes or no. Make sense? Make sense? So the conclusion is that you have to consider, you may have to consider. The rule of thumb is only start amortization when the product is launched. But yes, you need to consider some other contrary factors that may be provided to you in a question. Make sense? Make sense? So sometimes other factors may also give you a mindset, okay, I don't think this is technically launch. If it's a launch, why are you taking advanced orders? Right? Make sense? So that is why I told you that such a type of question always helps you in a live session, right? Because this is not a traditional question where you can say, okay, this will be the entry, this will be this, this will be this, this will be this. There is a discussion going on which will clarify your concepts even further, all right, and make you a strong accountant. So that being said, we were discussing the fact that $100,000 we have received as advanced booking deposit for Mendel, the new product. Your financial accountant, what he has done is he has debited cash and credited revenue. Is that the correct thing to do? Is that the correct thing to do? You guys tell me. Is that the correct thing to do? He recognized revenue of the entire cash that he received. No, these are just advanced bookings. You have not satisfied your performance obligation. You have received 2,000 orders of Mendel, but you haven't supplied one product even yet. So anything of this sort cannot be recognized as revenue, because according to IFRS 15, revenue can only be recognized when you have not when you have received an order, but when you have satisfied your performance obligation. In this case, we have only received an advanced order, and up till the year end, we have not supplied any of the product, and therefore no revenue can be recognized. We will debit our revenue by 100,000. Yeah. And credit advance income, or maybe I can call it a contract liability even, of 100,000. Make sense? Make sense? Is it okay with everyone? Remember, guys, we have been provided with a ready-made revenue in this question of 1,896,200. But at least 2 times we have seen that excess revenue was recognized by the financial accountant, by the financial controller, and that needs to be reversed. That needs to be reversed when we prepare our financial statements. Good to go? All good? Huh? Should I move forward? I hope so. Let's move forward, guys. Then we come on to note number 3. And let's see how many people are really studying hard. Let's see how many students are on the right track or not, right? It says on 1st of January 2015, that is 3 months before the year end, Gamow Limited made a one-off sale to a customer in mainland Europe. You living in subcontinent, you have made a sale in Europe. And that means you have made a foreign sale. You have made an export sale, most likely. Okay. The sale was of 22,000 euros. Your currency is the dollar. You see, the entire question was in dollars. And you have done a sale of 22,000 euros. And a 120-day credit was given to the customer. That means cash will eventually be received after the year end. Cash will eventually be received after the year end. You see, you did this sale on 1st January 2015. Your accounting year end is after 3 months on 31st March 2015. That means within the span of 90 days, your year end comes. But you will receive money after 120-day credit. That means the money will come after the year end. Money will come after the year end. That means your foreign currency receivable will be outstanding by the year end. It will stay as outstanding by the year end. The sale was recognized. It says the sale was recognized in revenue and receivables using the 1st January 2015 spot exchange rate. So what the guys basically did, I'll write it here. Working number 3, and this is foreign sale. Okay. So we did a transaction, a foreign transaction of, by the way, in euros of 22,000. By the way, we did this transaction on 1st January 2015. Okay. We did this transaction on 1st January 2015. Make sense? Now, this transaction was done in euros, but we prepare our financial statements in dollars. That means we need to convert this 22,000 euro into dollars by using an exchange rate. Local currency, we need to convert this transaction into local currency using a particular exchange rate. Examiner is saying that this transaction was converted into dollars based on the exchange rate which was prevailing on 1st January 2015, and the exchange rate on 1st January 2015 was 1 euro is equals to 0.83. So the exchange rate is 0.83. Exchange rate is 0.83. Can anybody tell me, if I need to calculate dollars, if I need to convert euros into dollars, do I multiply or do I divide? Do I multiply or do I divide by 0.83? Somebody is saying multiply, but why do I multiply? You see, it says that 1 euro is equals to $0.83. So 1 euro is less dollars. So more euros equal less dollars. So you have 22,000 euros, but this will be equivalent to less dollars. Less dollars. 1 euro equals less dollars, right? So 22,000 euros should be less than $22,000. So should we multiply by 0.83 to have a reduced answer, or should we divide? Use your common sense. It's not rocket science. You don't need to be a financial analyst to learn that. It's common sense. I multiply by 0.83. If someone was to say, no, sir, divide. Okay, 22,000 divided by 0.83. The answer comes as 26,000. It's more than euros. The exchange rate denoted to us that euros are more when dollar is less, or 1 euro equals less dollars. If you divide, you won't get the right answer. Make sense? Is this thing clear to everybody? So the local currency in dollars, you have a dollar amount of 18260. And what did your accountant do? What did your accountant do? No other accounting, the sale was recognized in revenue and receivables using the 1st January 2015 spot exchange rate. So your accountant made this accounting entry, receivables debit $18260 and revenue credit $18260. Is this okay with everyone? Done? Till this time, everything is fine. Please try to understand. Till this time, everything is fine. No worries at all up till now. But do you think IS 21 has any other implications here? Is there an implication of IS 21 here? Do you guys remember about IS 21? IS 21 said that if there is a monetary item, foreign currency monetary item is any item which is cash or readily convertible into cash, like receivables. If there is a monetary item, then at each year end, it needs to be retranslated according to the updated exchange rate. No retranslation is required in a non-monetary item. You know that. But in monetary item, you need to retranslate according to the closing date exchange rate, right? How do you do that? I will make three columns. One column for foreign currency, one column for exchange rate, one column for local currency. Okay. Make sense? By the way, you guys know na, foreign currency for us is euro, local currency for us is dollar, right? Make sense? And how do you go about it? You had some receivables, you had some receivables with a foreign currency value of 22,000, but a local currency value of 18260. Is everybody on the same page up till now? And you recognize these receivables on 1st January 2015. Is everybody on the same page? Done? You need to retranslate these foreign currency receivables on 31st March 2015 as well. How do you do that? You take the same foreign currency receivable. You see, even after 3 months, you still have to receive 22,000 euros from your customer. But now you need to retranslate them according to the closing date exchange rate. And if you go down, you see into the question, the closing date exchange rate is €1 0.79 dollars. So the exchange rate is 0.79. It was 0.83 before, but it is 0.79 right now. So at the year end, the dollar equivalent receivable that you have is 17380. Previously, it was 18260. Now it is 17380. That means the value of your receivables have been lost due to the exchange rate. As a result of balancing figure, you calculate an exchange loss, which is 880. Is this clear to everyone? Is this clear to everyone? No, Sanolak, not again. It's a loss. Your receivables were previously 18260. Now they are 880 less to 17380. Right? It's a loss. Sir, what should be the accounting entry? Can you tell me? Why not? I'm always there. Your receivables are reduced due to this exchange loss. So receivables credit by 880. Yeah. What do you debit? Exchange loss. You debit your P&L. You debit your P&L by 880. Make sense? Is it clear to everybody? Is this clear to everybody? The implication of IS 21 comes into play. You guys let me know. Is this clear to everybody? Very good. Exactly. Please let me know your answer. Is it clear to everybody? So two things we have to do. First, make sure that you decrease your receivables when you are preparing your financial statements. You decrease your receivables. And the next thing is you will have to recognize an exchange loss in your books. You will have to recognize an exchange loss in your books of 880. Make sense? So now we have done note number 3 as well. And now is the time that we move on to note number 4. Now, note number 4 is a very traditional note. But let's see how many of you guys remember or not. I am again telling you, take it as a mock. It's a test that is happening in front of you. Every now and then people message me, sir, will you take a mock? 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 And then I take a mock. Nobody comes. Nobody comes. Nobody comes. Nobody comes. Nobody wants to attend a mock. Everybody wants a mock, but nobody wants to attend a mock. Everybody likes, sir, you take a test, but we are not going to give the test. Sir, you take a test and then you tell us the answer. And if we do not understand the answer, you explain us the answer. And then you say, sir, it is a test. Many a times I'm surprised, I'm amazed that what do you guys actually want? You know what? You are just being complacent about it. You are just being complacent about that. I'm not pointing out anybody. Yeah, it's a general thing. It's a general thing. Like you see, everybody says, "Sir, take a live class." Okay, we have a live class every week. Will you come? No, no, sir. I'll take the recording. Oh, hey, what's the point? What's the point? So that's the funny part of teaching you guys, right? So everybody wants a live class, but nobody wants to attend it. Everybody wants a mock, but nobody is going to attend it. That does not make any sense, right? So treat it as a mock, okay? Note number 4, guys. Let's see how many of you can do it. It says that on 1st April 2014, on 1st April 2014 means it's the start of year. Gamow Limited issued 30,006% $10 convertible loan notes at par. Not a difficult thing. It's working number 4. You have issued some convertible bonds. And you know how to treat convertible bonds, right? It is already defined under IS 32. You need to split the debt component and equity component. Present value of all cash flows that arise on that bond is debt component, while the residual is the equity component. Understood by everyone? Yeah, that's the thing. Examiner says on 31st March 2017. You see, you issued the bond on 1st April 2014. And again, it's a convertible bond. $30,000 10 convertible bond. $30,000 10 means you would have received cash of 300,000. You can also see it is there in your trial balance as well. $300,000 worth of bond. So you would have received cash of $300,000, and as per IS 32, you should have credited your financial liability, and you should have also credited equity option with some value. Remember, we need to split account. We need to do split accounting. Make sense? Yeah. So it says that on 31st March 2017, which is 3 years after, on 31st March 2017, each bond can be redeemed for cash at par or converted into 3 ordinary shares. The interest due on the bonds was paid on 1st April 2015. The interest was paid on 1st April 2015. The equivalent effective interest rate on similar bonds without the conversion right is 9%. The only accounting entries made at 31st March 2015 were to recognize the $300,000 cash received as a non-current liability. You see, the original accounting entry, you see, please focus on the original entry that should be made should be cash debit, financial liability credit, equity option credit. This should be the accounting entry. This should be the accounting entry. But what accounting entry has your examiner made? Please look at it. Please look at it. What is your accountant's entry? The only accounting entries made at 31st March 2015 were to recognize the $300 cash received as a non-current liability. Your examiner has made the accounting entry cash debit 300,000, and financial liability credit 300,000. Is this correct accounting by the controller? Is this correct accounting by the controller? You guys tell me. Is this correct accounting? Guys, tell me, is this correct accounting? You should have made the accounting entry cash debit, liability credit, equity option credit. Your accountant has not credited any equity, but only recognized the liability. This is not correct accounting. So, sir, what do we need to do? You need to perform split accounting. First of all, you calculate present value of cash flows. Guys, this is a 3-year bond. So for 3 years, year 1, year 2, year 3, you pay interest. You pay interest. Huh? How much interest do you pay on this bond? How much interest do you pay on this bond? Can anybody tell me? How much interest do you pay on this bond? You see, it's a $300,000 bond. It's a $300,000 bond. And the coupon rate on this bond is 6%. It's 6%. So each and every year, 300,000 worth of bond, you would have multiplied by 6%. The cash flow, the interest, the amount of interest that you would have paid each and every year on this bond would be 18,000. First year it is 18,000, next year it is 18,000, third year it is 18,000. And at the end of year 3, you would be paying the principal amount back. The principal amount would be 300,000 again. Make sense? Now, IS 32, IFRS 9 requires you to calculate present value first. And you would need to calculate present value. And for that, you will need a discount rate. What should be the discount rate? Should that be 6%? Should that be 6%? No. Discounting is done on the effective rate, on the market rate, and it is written here, guys. It is written here. The equivalent effective interest rate on similar bonds, that is the market bonds, is 9% per annum. Make sense? Is it clear to everyone? Discounting is always done on market values. Discounting is always done on effective rates. I've 1,000 times I've told you, discounting is always done on market rates, market values. So you need discount factors on 9%. How do you calculate? 1 is equals to 1 divided by 1 plus R. R is 0.09 raised to the power shift 6 in Excel raised to the power 1, right? Then you copy this formula, Control C, come on the below cell, Control V, then double click on the cell, you go and double click on the cell, remove this one, make it to 2. Then you copy this formula again down, double click, remove this 2, have it 3. And then use the same discount factor in the last year as well, because the principal is going to be paid here. As somebody is asking, sir, can we do it from the annuity factor? For sure. For 100% for sure. No worries at all. Right? Then you calculate the present value. 18,000 multiplied by 0.917, 18,000 multiplied by 0.842, 18,000 multiplied by 0.772, 300,000 multiplied by 0.772. Here you will get, when you sum all of these, is equals to SUM sum, bracket open, you select all these cells, 277218. By the way, you can apply these formulas. You can apply these formulas in your exam too. If somebody says, sir, I cannot apply some formula. First of all, if you cannot apply some formula, there is terribly wrong something. There is something terribly wrong. But still, if you cannot remember how to apply is equals to sum, is equals to go towards the first cell, select it, then plus second cell, plus move your cursor towards the third cell, plus if you don't remember, go towards the fourth cell, plus enter. Okay, somebody is asking, sir, can you please tell again what is the discount formula? Huh? You see, discount formula is 1 divided by 1 plus R raised to the power n. N. This is the formula for discounting. This is the formula for discount factor. By the way, most of the times, 99% of the times, examiner provides you the discount factor himself in FR paper. In F9, obviously, everybody needs to calculate on their own. But 99% in FR cases, you see, you are already provided with the discount factors directly. But you see, we are becoming chartered accountants, right? And if you're even attempting to become a chartered accountant, you should be very well versed with these basics. So the formula is 1 divided by 1 plus R raised to the power n. How do you apply it on Excel? You know, I'll simply click on a particular cell and let you know. Is equals to, put is equals to so that formulas can work. 1 divided by 1 plus R. R is 0.099%. And then you apply shift 6 for this sign. Shift 6 for raised to the power sign in Excel. And then when you have done that, write 1. Write 1 for the first year, write 2 for the next year, write 3 for the third year, write 4 for the fourth year, write 5 for the fifth year, so on and so forth. And there you will get. In FR cases, there is a 99% chance that you will be pre-provided. You will be pre-provided with discount factors. But you see, my point of view is, why should we rely on the examiner? We should know how to calculate discount factor at the very least. It is the minimum expected out of chartered accountants, right? So now, yes, you can follow this as well. So guys, tell me, do you understand? Ansh, do I answer your question? All right. So this is the present value of cash flows, which is known as the debt component, right? This is the debt component. All right. Then you compare this debt component with the amount of consideration received, which it was received 300,000 against this bond. The remaining, the residual is equity option, right? So the accounting entry that should have been made is cash debit 300,000, liability portion credit 277,218, and equity option credit 22,782. This should be the correct accounting entry. This should be the correct accounting entry. Is it clear to everybody? Is it clear to everybody? Let me know. Is it clear to everybody? Sanola, what should I repeat? Cash debit 300,000, the liability component being present value of all cash flows, the debt component, and the rest is equity option. The rest is equity option. Cash debit, financial liability credit, equity option credit. This is the accounting entry that should have been prepared. Is it clear for everyone? And I want an answer from everybody in the class, not just few people, right? I want an answer from everybody. Is it clear to everyone? Guys, Ansh, you tell me, this should have been the accounting entry, whereas accountant classified everything as a non-current liability, everything as a financial liability. Certainly, this is not the correct pattern. There must be a correcting entry. Can anybody tell me what should be the correcting entry in this scenario? What should be the correcting entry in this scenario? Your accountant credited whole financial liability, whereas they should have only credited 277,218, and rest should be equity option. What should be the correcting entry? Financial liability debit 22,782, equity option credit 22,782. Excellent, right? And I'm repeating it again and again, again and again, so that people do not ask me individually. Making accounting entries is not required. If you can do so without making accounting entries, that is okay. That is preferable rather, because it will save you time. But if you are an accountant like me, a desi accountant like me, I would always want to make accounting entries and make my concept very clear. All right. Now this is done. This is done. All right. So after this has been done, you guys know now, once your debt component has been correctly identified as 277,218, you need to prepare a amortized cost schedule. Do you guys remember or not? You need to prepare an amortized cost schedule. Yeah. And how do you prepare an amortized cost schedule? You have certain columns to prepare. There was date, amortized cost brought forward, then there was interest, expense, then there was interest paid, and then there was amortized cost carried forward. Do you all agree? You guys should remember this by, huh? So we made this issue on 1st April 2014 at the start of the year. And through this issue, our liability to be recognized in our books is 277,218. Our accounting year ends on 31st March 2015. Yeah. Brought forward should be the same, 277,218. We will be recognizing an interest expense. We will be recognizing an interest expense, Ansh, which is always based on the effective rate, which is 9% in this case. Yeah, which is 9% in this case. So 277,218 multiplied by 0.09 The expense amount should be 24950. Make sense? Very good. Then interest paid should be calculated on 6%. You guys are right. Excellent. But wait. It was written the interest due on the bond was paid on 1st April 2015. The interest due on the bond was paid on 1st April 2015. That means till the accounting year end, no interest was paid. Yes, you are right. It was supposed to be calculated at 6%, but it was paid not within the year. It was paid, 1st April 2015. First day of the next accounting period. So technically within 31st March 15, nothing was paid. And that means your carried forward balance of your liability should be this 302168. Do you all agree? 302168. Under this 302168, your current liability is 24950, because the 24950 interest will be paid next day. Yeah. And rest of it should be a non-current liability, which is 277,218. Is everybody clear on this? Please let me know, is everybody clear on this? Is everybody clear on this? Yeah. And do remember, by the way, your interest expense will be recognized at 24950 in your P&L. 24950 will be recognized in your P&L as a finance cost. Done, guys? Done? Zainab? Clear? Very good, guys. Excellent. Very good. Note number 5. On 1st April 2014, which is the start of the year, a legal claim was made against Gamow Limited in relation to a delivery of goods which were of poor quality. Can anybody tell me which accounting standard comes into your mind when you read this type of a narration? Somebody has made a legal claim against you. Which accounting standard comes into your mind? IS 37. Agreed. Somebody is putting up a legal claim against you. Now, if there is probable outflow, there should be a provision. If the outflow is virtually certain, you should recognize a liability. If it's a possible liability, then you only provide a disclosure, so on and so forth. You know what IS 37 says, right? It says on 1st April 2014, a legal claim was made against Gamow Limited in relation to delivery of goods which were of poor quality. This was an isolated incident. So guys, it's written that on 1st April 2014, a legal claim was made against Gamow Limited. 1st April 2014 basically means start of the year. So on the first date of the year, we were exposed to a legal claim made due to provision of poor quality goods. This was an isolated incident with a fault with one of the production machines, and the goods should not have been delivered to the customer. Although they were, but this was a fault and we accepted. Gamow Limited's legal department believe that the claim is likely to succeed, and an out-of-court settlement is estimated at $120,000. You see, it is probable that we will have to pay 120,000. It's not virtually certain because the out of court settlement is yet to be done. It's not done, it's yet to be done. Make sense? It's not done already. So it is probable that $120,000 would be paid. Should we recognize this as a provision? There is present obligation because there is a court case outcome going to come. There is probable outflow because legal department likely believes that $120,000 is to be paid. There is a reliable estimate available. Legal department says you'll have to pay 120,000. So all of the conditions are met. Provision should be recognized. Examiner says a provision was recognized at 31st March 2015 for $120,000 and the cost was debited to other operating cost. They are saying we have already recognized the provision. And you can see this in the trial balance as well. You see, here you see the provision is 120,000 and the expense element is contained within this other operating cost. Perfect. Perfect, my fellows. Perfect. Examiner has done everything. If examiner has done everything, why is he giving us a note? Your examiner is saying, please listen to me. A provision was recognized for $120,000 and the cost were debited to other operating cost. However, listen, due to a number of complications with the claim, it is estimated that the claim is not likely to be settled until April 2016. You see, you are standing on 1st April 2014 and your lawyer say that the claim is going to be settled for $120,000 after 2 years. After 2 years. Guys, a liability, a liability is a present obligation arising as a result of past events. Mainly, I mean, I know that the definition is vast, but thinking conceptually, a liability is a present obligation. It is an obligation. You see, it's an ongoing court case, so it's an obligation. But IS 37 or framework says a liability is to be recognized which represents your present value of obligation. Now you have to pay $120,000 not now, but you have to pay $120,000 2 years after. 2 years after. So shouldn't we be calculating present value of cash flows? Your examiner has recognized the entire $120,000 as provision. I say that we should be calculating present value. Present value of cash flow should be calculated. Examiner is saying the appropriate discount rate is 7%. Yeah. So how do you do it? The provision likely amount was how much? 120,000. You will discount it for 2 years at 7%. How do I calculate discount factor? 1 divided by bracket 1 plus R 0.07 raised to the power shift 6. Okay, shift 6 raised to the power 2 because we are discounting for 2 years. 0.873. So 120,000 multiply by 0.873. This is, if I remove the decimal places, 104813. This is the present value. Your examiner has recognized the entire 120,000 as provision, whereas the liability on 1st April 2014, the liability should be 104813. The liability should be 104813. Recognized by accountant is 120,000. That means on 1st April 2014, something should be reversed. Can anybody of you tell me the correcting accounting entry? To be recognized, but recognized by accountant. Reversal. Okay, there is a question. Sir, why do we discount for 2 years? Till year end, it should be 1 year. I'm coming back to your question, Fayaz, in 1 minute only. 1 minute. Give me 1 minute. Promise 1 minute. Okay. First of all, if we stand on 1st April 2014, the date, the legal case was initiated. The date we took legal advice from our lawyer. At that date, it was 1st April 2014. Examiner incorrectly recognized a liability of 120,000. It should have been 104813. There should be a reversal of 15187. The accounting entry for this reversal, let me just make the accounting entry. Again, it's not required, but still. Provision We decrease, we make it a debit 158187. Yeah. And P&L or other operating cost, credit 15187. Make sense? Make sense? But sir, the question is, sir, you are doing all of this on 1st April 2014. Our year end is 31st March 2015. Sir, what do you do at this date? What do you do at this date? My fellows, if you have discounted a particular cash flow, and don't say you don't know, you don't know this, please. Don't be foolish. You know this. If you discount a cash flow, then you also need to unwind it now. Haven't you read about this? The similar thing you have read about this in your compulsory disposal cost lecture as well. This is common phenomena. If some cash flow comes back, it also has to go in future as well now. There will be unwinding. There will be unwinding. You know, unwinding is finance cost. Yeah. As the time unfolds, as 1 year is passed and you come up to 31st March 2015, you are 1 year ahead. And since you are 1 year ahead, you will need to compensate the other party for the time value of money as well. How do you calculate unwinding? This is 104813 into 0.07 being 7%. This is 7337. Fayaz, 7337. And what accounting entry do you make, Fayaz? What accounting entry do you make? You make finance cost or interest expense debit 7337. Yeah. And what? And provision credit. You update your liability with this amount. You update your liability with this amount because it's 1 year after. Make sense? Everybody got it? What should be the total liability to be reported in your balance sheet? SOFP provision, if you were to tell me. Your initial liability should be 104813, but that should be increased by 7337 by the accounting year end. So 112150 should be your liability. Make sense? All good. Very good. Excellent. You guys are very smart, by the way. MashaAllah. Let's go for working number 6, guys. We are short of time. Okay. So it says that depreciation on property, plant and equipment for the year ended 31st March 2015 has not yet been charged. Very good. We will charge it on our own. It says all depreciation is charged on straight line basis. Thank you very much. It says buildings were assessed as having 40-year useful life and the plant has a useful life of 15 years. Building 40, plant 50. Good. You have 3 items in your PP&E at cost value. At cost value, there is land, but land is not depreciated. There is buildings of 1080. There is plant and machinery of 384900. All right. Examiner says no new items of property, plant and equipment were acquired during the year, although a machine was sold on 1st April 2014 for 9300. So basically, you see, there are 2 portions to it. Let me calculate it one by one. Depreciation on building. How do you calculate depreciation on building? If anyone could tell me. The cost value is 1080,000. So 1080,000 divided by 40 years. What is your depreciation for this year? 27,000. Make sense? 27,000. All right. But for machinery, there is something different. And I'm 110% sure that anybody who does not listen to me from now will miss the concept out and will keep on thinking about the mathematics that has been applied. And that would be so tough for me to explain. Oh, no, no. Because it's basic math plus minus. Oh. Telling you about plus and minus at this age will be very difficult for me. Oh. 8th class mathematics. It says that no new items of PP&E were acquired in the year, although a machine was sold for 9300. A machine, one machine was sold for means the selling price for 9300. Okay. It says the machine had originally been purchased for 19,500. When was it purchased? On 1st April 2008. You see, let me tell you, there is a disposal of machinery. Okay. The machine that has been disposed had an original cost of 19,500. Make sense? When was it purchased? It was purchased on 1st April 2008. You are standing on 31st March 2015, my dear. Sorry, you sold this on 1st April 2014. You sold this on 1st April 2014. You bought this on 1st April 2008. Can anybody tell me what was the accumulated depreciation? How many years of accumulated depreciation would have arisen up till now? 2008, it was bought. So till 2009, first year, 2009, 2010, 2011, 2012, 2013, 2014. 6 years. 6 years depreciation would have passed. So 19,500 was the assets value. Total useful life is 40. Sorry, total useful life is 15 for all machinery. It was written somewhere. Yeah, 15 for machinery. 6 years would have passed up till now. That means 7,800. 7,800 accumulated depreciation would have occurred on this. Let me know. Is there anything that you do not understand up till now? Believe you me, this is 8th class mathematics or a financial accounting level paper knowledge. This has nothing to do with FR paper. This is very basic. Is everybody okay? Is there any person who do not understand how I have this calculated this? Clear? 6 years have passed. I divided by 15 to get 1 year's depreciation, multiplied by 6 so that I get 6 years depreciation. All right. Net book value 19,500, 7,800. The net book value would have been 11,700. We sold this asset. We sold this asset for 9,300. That means there would have been a loss on disposal of 11,700 item was sold for 9,300. That means there is a loss of 2,400. Is it clear to everyone? Is it clear to everyone? Make sense? Don't tell me you don't understand this. It will be a shocker for me. Right? Understood? Examiner says the only accounting entries made in respect of this disposal were debit to cash and credit the cash to non-current asset. You see, when a disposal happens, what should be the original entry? What should be the original entry for a disposal? You receive cash. See, everybody needs to focus. Huh? Everybody needs to focus because there is no repeat telecast. Cash debit of 9,300. Asset, you sold an asset. You sold an asset which had a net book value of 11,700. So cash debit, asset credit, cash debit, asset credit. And when the accounting entry does not match, when the accounting entry does not match, there is a balance of loss on debit side, which is this. Guys, tell me, do you all agree? Not some people, yeah, I need an answer from everybody. This should be the original entry. Loss goes in P&L. Make sense? Everybody, please answer. Yes. What your accountant has made. Accountant's entry. Accountant Bhai Saab has made this accounting entry. Cash debit 9,300 and asset credit 9,300. Is this correct accounting entry? No. Your asset should have been credited by book value of 11,700. It has been credited by 9,300. That means less asset was credited. What should be the correcting entry? Guys, what should be the correcting entry? You debit your loss in your P&L of 2400 because no loss was recognized by the accountant. No loss was recognized by the accountant. And what you credit your asset. You credit your asset by 2400. Again, my fellows, no accounting entries are required in your exam. Why do I do this? My choice. Because I'm a teacher. You are not a teacher. Nobody is expecting you to be a teacher. Just go in your exam, do tish, solve your answer, and come back. Make sense? But is it clear to everybody? This should be the correcting entry. Remember, you need to recognize a loss on disposal. Is it clear to everyone? Yeah. Is it clear to everyone? Please let me know. Please let me know. Sir, we still have to calculate depreciation on machinery now. There is a very important question and I will answer this once and for the very last time. Sir, can we make all these adjustments in our rough paper? And just write the answer. We just write the answer in our spreadsheet. Would that be fine? Yes, it will be perfectly fine. But in that case, you will need 2 attempts. Okay? Because in this attempt, you won't pass. It's as simple as that. Sir, can we at least make accounting entries on a rough paper? We are provided with a paper in exam, right? Can we just make, for our own sake of clarity, we can make accounting entries on our paper, but still do the workings on Excel? Is that okay? Yes, that's fine. But if you solve all the adjustments on a rough paper, my dear, welcome to the next session as well, because you are not going to pass. Make sense? I hope I've answered, right? So all workings are to be done on spreadsheet. Why would examiner give you a spreadsheet if you are doing it on a paper? He could have easily given you a paper rather. It makes no sense now. So depreciation on machinery, guys. How do you calculate depreciation on machinery? We have to follow straight line method, guys. Anybody who could tell me how to calculate depreciation on machinery for the year? Plant and machinery has been given to us with a value of 384,900. How do I calculate depreciation on machinery? Tell me, guys. I will give you 1,000 rupees if you tell me right now. Please don't answer. The value of plant and machinery is 384,900, guys. Make sense? One item with a cost value of 19,500. Remember, this is straight line method. So cost divided by life. So 384,900 minus 19,500 is a must. Because this 19,500 item was sold on 1st April 2014. The first date of the year. First date of the year. So it wasn't used during the year. No depreciation on it. Common sense. Divided by not 40, 15 years. Make sense? Is it clear to everyone? So depreciation on building would be 27,000, depreciation on machinery would be 24,360, and loss on disposal would be 2,400. Is it clear to everybody? Is it clear to everybody? Guys, is it clear to everybody? Good to go? Very good. Examiner says all expenses in respect of property, plant, and equipment should be recognized in administrative expenses. So everything that we just saw, this thing, it will be recognized as part of admin expenses. Okay, that's fine. We'll do it. Make sense? All right, let's move forward. Working number 7. Working number 7. Examiner says, guys, note number 7. During the year, the finance director reviewed Gamow's limited accounting policies. As a result of this review, he decided to change the accounting policy for freehold land from historical cost to revaluation, as he felt that showing the land at valuation would result in more relevant information to users. So basically, for your land, he has selected the revaluation model. And that's fine since it represents more relevant information for users. You know, ISA, it allows a change in accounting policy, which is either required by the standard or it results in more faithful representation. This change is allowed. It says that at 31st March 2015, which is the year end, the land was to be valued at 500,000. You see, land in your books right now, the carrying value of land in your books right now is 350,000. Agreed? Agreed? When you revalue the land, the fair value is 500,000. That means there will be a revaluation gain. There will be a revaluation gain of 150,000. Is it clear to everyone? Simple accounting entry, land debit, OCI or revaluation reserve credit. Is it clear to everyone? I'm not making the accounting entry just to save time, but is it clear to everyone? Land debit, OCI or revaluation reserve, whatever credit. Make sense? All good? All good? Let's move forward. Why waste time? Working number 8, guys. It says inventories at 31st March 2015 were valued at their cost of 47,300. Inventories. Okay. So examiner is providing us closing inventories. Examiner is providing us closing inventory of 47,300. Now it's a test for everyone. This included 9,000. So 9,000 is already included in 47,300. Okay. This included $9,000 in respect of one product, which had a total list price of $12,000 at 31st March 2015. You see, your examiner is saying this closing inventory includes an item which has a cost of 9,000, but has a list price. List price means a selling price, right? A list price of 12,000. However, on 1st April 2015, the directors discovered that since March 2015, a number of competitors had been selling an equivalent product for 30% less than Gamow's list price. Shouldn't we be calculating NRV? Shouldn't we be calculating NRV, net realizable value? If the competitors are offering 30% discount, most likely we will only be able to recover 30% discounted price from the market. Our normal price was 12,000, but we can only offer it for 70% of the original list price, which is 8,400. And according to IAS2, inventories should be recorded at lower of cost or NRV. NRV is 84, cost is 9,000. What do we select? We select the lower of. Yeah. So 9,000 is already included. So I will say less cost of inventory, 9,000. And I will say rather add the NRV of inventory, which is 8,400. So final inventory value should be this. Does everybody agree on 46,700? Does everybody agree on 46,700? And I want feedback from everyone. You see, everybody has to go in their examinations. You cannot rely on what I'm saying or what anybody else understands. You have your own paper. Is it clear? Perfect. Excellent. The last thing, note number 9. The income tax for the year has been estimated as 74,000. Can anybody tell me what should be the accounting entry for this tax? Income tax entry. Entry. What should be the accounting entry, guys? What should be the accounting entry, guys? Don't tell me you don't know the accounting entry. Yeah. Very good. Yes. Tax expense debit 74,000. Provision for tax or current tax liability, whatever you call current tax liability credit 74,000. Make sense? All good? Is it okay for everyone? Done? Now, guys, you see, technically speaking, we have solved the entire question. Just now we need to prepare PNL and SOFP, nothing else, not too difficult. This can be done within few minutes. But before we do that, let's prepare some more workings. Let's prepare some workings for cost of sales and administrative expenses and maybe other operating costs as well. Let's prepare working for cost of sales in advance so that it's easier for us to prepare a P&L. Cost of sales working. We'll start with opening inventory, add up purchases, add up all relevant expenditures, pertaining to cost of sales. Okay. Like we will add, let's see what we can add in cost of sales. What can we add in cost of sales? Okay, so there was a loss of 880. This can be treated under cost of sales. Yeah. Then there, yes. Remember research cost? We were developing a product, research cost of developing a product related cost of sales. This we can take. So let me just write it down as well so that we don't forget. Add research cost, maybe add exchange loss. Yeah. Anything else that comes into your mind that can be added in, cost of sales? Anything else? So technically, obviously, interest expense cannot go into cost of sales. We can take this provision in. Okay, so this was in other operating costs, not required. All of assets thing go in administrative expenses. I think nothing. It will be simply less closing inventory. Yeah. So please tell me the values if you can. You might remember. 45,600 and 569,130. Remember this, 45,600, 45,600. I forgot. And the other number was 569,130. Yes, 569,130. Research cost was okay. Yep. Research cost was 115,000. Exchange loss was where is the exchange loss? 880. Yes. Yes. Closing inventory. What is the final figure of closing inventory? We just did a working for it, guys. Just did a working for it. 46,700. Excellent. So what should be the cost of sales? Sum it all up. The cost of sales should be 683,910. Done. Now let's do working for administrative expenses. So for administrative expenses, we will start with what has been provided to us in our examination. Administrative expenses and other operating costs, two workings we need to do. Other administrative expenses is 283,600. So I will write as per trial balance. What was the amount? 185,600. Was this the amount? 283,600. I don't know where did 185,600 come from. 283,600. Sometimes it happens that I'm solving a question and sometimes I forget a number because I'm speaking so much. So my mind is more diverted towards speaking. I forget some numbers and people, text and message and they always say that, you forgot the number. It does not make any sense, right? So, let us continue. Yep. So as per trial balance, administrative expenses are 283,600. What was there to be done in, yeah. So there was some depreciation and loss on disposal to be written here. We will write depreciation on building, depreciation on machinery, yeah, and loss on disposal. Depreciation on building is 27,000. Depreciation on machinery is 24,360. Loss on disposal is 2,400. And this is how you link your cash flow. You link your answer is equals to go to the relevant cell, click and press enter. When you do that, your entire answer is linked. Your examiner can just double click and see where is this number coming from. He will give you full marks. He'll be so happy. Yeah. So the whole number is 337,360. The last working that we could do is of operating cost. We can start by saying that what is as per trial balance 189720. This is the amount. Other operating cost had to be adjusted for this provision. Yeah, 15187. I'm sorry. Reversal of excess provision 15187. Net operating cost should be this 174,533. Done. Is it clear to everyone? If that is so, now we are left with the most easiest part that you can think of. The most easiest part is now to come. Is it clear to everyone? We can also calculate adjusted revenue. You are absolutely saying right. But just for the sake of, timeliness, let us just do it directly. Yeah. So let us do working number 1, part number A. We are going to prepare a statement of profit or loss for the year ended 31st March 2015. Let's start with revenue, guys. Revenue, we already had 1896,200 mentioned. So 1896,200 already there. Remember, we had to reverse some amount of revenue, 156,250 from the first working. Then from the next working, we had to reverse advance deposit from Mendel. And that was it, right? This is the revenue that we need to reverse. It should be 163,950. Is it clear to everyone? And please, if I make any mistake, you guys can stop me there and let me know, sir, you have made this mistake. Okay. Cost of sales. We already did working for this. Is equals to, press is equals to, with a minus sign. With a minus sign will give you a negative answer for cost of sales, which you need. So is equals to minus, move your cursor, guys, move your cursor, arrow keys, use your arrow keys, come down. Where is your cost of sales? We already prepared it to save our time. Cost of sales 683,910. Come to it, press enter. The link figure is here. Then you will get gross profit of 956,040. Make sense? Then you write administrative expenses. Then you write other operating cost. Yeah, we had already done these. Administrative expenses were 337,360. Other operating cost was come down 174,533. Done. Then we will come at profit before interest and tax. Yeah. 444147. Then there is interest, which is finance cost. Remember, we already had some finance cost ready made in the trial balance, 1560. So 1560 minus. Then there were at the very least two finance costs, which I remember. One was this finance cost of 24950. And the other one was 7337, which was the unwinding. Remember, guys, unwinding. There you have it. Interest cost of 33,847. Profit before tax. This is this 410,300. Tax. Remember, it was 74,000. Let me just confirm. Yes. Oh my God. Now you have profit after tax. This 336,300. Add other comprehensive income. We have only one other comprehensive income, which is of revaluation gain. Remember, revaluation gain was there on your land. Land had revaluation gain of 150,000. And then there is total comprehensive income of this plus this 486,300. Make sense? And now, without any further ado, let's go to statement of financial position. So, statement of financial position as at 31st March 2015. We'll start with assets, and in particular, non-current assets. Somebody says, why are you not preparing a statement of changes in equity? Because it's not required. If it's not required, why do I prepare it? Yeah. So I prepare non-current assets first. We'll write property, plant, and equipment. And we have two types of non-current asset, guys. One was property, plant, and equipment, if you can see in the trial balance, and the other one is intangible assets. So two things. Right? So property, plant, and equipment. The carrying value of property, plant, and equipment already given to us was 1260780. 1260780. But there are certain adjustments that need to be done in this opening balance. First of all, no depreciation was recognized. We will recognize it. No disposal was recognized. Remember, the disposal was recognized with a less value. The sales proceed was credited into non-current assets. We will take that impact as well. Plus, no revaluation had been done by your examiner. We will do that. Huh? So 1260780 is the value of your examiner. I'll go towards the right. I will go towards the right, guys, and make some adjustments. I subtract depreciation. Yeah. I subtract depreciation on machinery. I subtract additional 2,400 of the loss that had not been accommodated by your examiner. But I will plus, see the working, plus I will add the revaluation gain. Make sense? I mean, you could have done it manually as well. I like to link my numbers. But if anybody could have done, with writing the numbers by themselves, that could have also been done. So 1357020 is your property, plant, and equipment. Intangible assets. Remember, only some part of the development cost could have been capitalized. Do you guys remember? Remember, only $160,000 was to be capitalized. Only 160. Rest did not meet the criterion. So 160,000 here. You have total non-current assets, and then you can call about current assets. Current assets will have inventory, receivables, and any cash and cash equivalents maybe. Yeah. Remember, we calculated our final figure of inventory, lower of cost or NRV. We calculated final figure of our inventory of 46,700. Remember, after making NRV adjustments and everything, 46,700. We have our receivables ready-made, guys. We have our receivables ready-made, 121,240. But I'm going to subtract the loss. Remember, there was a foreign currency loss, exchange loss, 880. P&L debit, but there will also be a receivables credit. So receivable credit. Done. And if you can see the question, there are ready-made cash and cash equivalents given of 3,800. These come as it is. So what should be our total assets? What should be our total assets? Guys, if you can help me out on this. Our total assets are 1687880. Understood? Please give me a thumbs up if everything's fine up till now. Please give me a thumbs up if everything's fine up till now. Okay. Then we are going to go for equity and liabilities, right? First of all, let's go with equity. First, there will be ordinary share capital. Then I will take your support to calculate retained earnings. Then we will have revaluation reserve in this question because the company changed their accounting policy. Ordinary share capital, 580,000, right? Retained earnings. Can anybody help me to calculate retained earnings? Because there was a 238,170 loss in opening. Loss. So it was minus 238,170. Minus. But you will be adding this year's profit, guys. Plus PAT. This year's profit, 336,300. Eventually, it becomes a positive number of only 98,000. Make sense? During the year, some revaluation was done, and therefore your revaluation reserve would be 150,000. You know where it comes from? That should be your total equity. What about your liabilities? First, we will talk about non-current liabilities. In your non-current liabilities, guys, in your non-current liabilities, there should be a convertible loan, right? There should be a provision against legal claim. Yeah. Then if you remember, there was some unrealized revenue, contract liability, remember? That should be there. If anything else needs to be there, just remind me, okay? So convertible bonds, the value of convertible bonds in non-current liability is 277,218. Then there was provision, which needs to be, remember we calculated total provision including unwinding 112,150. And then there is a contract liability. The contract liability was 31250 for non-current. And then there will be some current liabilities as well. These will include trade payables, right? These will include trade payables, some contract liability. Anything else that should come? Tax liability. And then there was some interest payable as well, right? These are the things that at least I remember. Trade payables are 92,400. Contract liability. Remember, current liabilities, remember 125,000 from here. 125,000 from here. Plus there is a contract liability of 100,000 here. Is there any other liability? I don't think so. So this is 225,000. Tax liability should be 74,000. Interest payable should be 24,950. I don't know if that is it. Anything else? I don't know. Let us just balance. Let's see if everything has been done. Let's save time and brain. Okay, so there is a difference and we'll straightforward know what we have left. Can anybody tell me what is this 22782? I know. What is this 22782? I have missed something. No, it's not a current liability. It's not a current liability. How can you say it's a current liability? It's an exact value. Remember equity option from convertible loan notes. Remember? Equity option from convertible loan notes. It is the exact figure. Since I'm solving the question, I remember the values. When you will be solving on your own, you will remember the values too. So yes, when I write this equity option from convertible loan note, the balance sheet is balanced. Guys, do you understand this? And I want an answer from everybody. I want an answer from everybody. Is it clear to everyone? Because if it's so, voila, class, finish, finito. Sir, don't you think this was a very lengthy question? Should we expect the same in paper? No. And that is why when I started this lecture, I told you, sir, this is a practice question. Take it as a mock question. Take it as a challenging question. You cannot do everything with the intention of having it in exam, because that's not learning, right? You come to me, you want to learn financial reporting, you want to learn what I teach. You just don't, it's, you see, from my perspective, learning how to solve a particular Kaplan question is just not worth it. What's the point of coming to me if you cannot understand the broader perspective? Yeah. So that is why I took this opportunity to solve a longer question with you guys. Consider it a 40-mark question. Yeah, I'm very sure this kind of a, these are very lengthy adjustments. Most likely when you go in your exam, 4 or 5 adjustments would come. Here, 9 adjustments were there. So obviously it increases your time to solve the question. Plus I explained more and more. That took me more time. But is this good enough for practice? Yes. Is this good enough to benchmark? Maybe no. Yeah. So is everybody clear on this? Yeah. Just consider this in mind. Take it as a challenge. Sometimes we do something as a challenge. If a person needs to run 100 meters, he would need to practice for 200 meters so that the first 100 meters become easy for them, right? You play test matches, you even become good at one day internationals, you become good at T20s, right? So you do something tough so that, easier things become more easy for you. All right. So that's the perspective. Okay.